What do you think about the correlation between interest rates and cap rates? Is it really playing out?
I think we're seeing it. On the industrial, again, with the mark to market, we're seeing cap rates still hover in the 5 range, somewhere between as high as 6 and as low as 4 3/4. But debt is it's a component of cap rates. It's part of the mixture to define what cap rates can be. So there's definitely upward pressure still on cap rates. With interest rates rising, the Fed is rumored to be raising rates again. So cap rates inevitably are going to have to follow that.
And what, if you had to describe going through an acquisition, because we bought a few things since interest rates have gone up, what would you say the psychology of a seller is right now versus our psychology as a buyer?
So we have the psychology of a vast majority of sellers is they don't believe it. There's a bid-ask spread. They're not going to move down to the bid. So they're just not sellers. We've seen assets that we bid a year ago that are now 20-25% less in price. Some sellers just aren't willing to acknowledge that. The guys that are people who are selling all the time in the market, just like the equity partner who said that are buying all the time in any market, those guys realize that it is what it is. We need to sell for business reasons, and they're selling. And we're trying to find those sellers and get very close to them.
So you did mention we do buy with leverage. We're not a REIT that can use our equity or our stock to buy things. What is your take on the available debt out there? I mean, we saw Silicon Valley Bank blow up. I mean, that wasn't a big commercial real estate lender,
Right.
but it certainly affected people like First Republic. It certainly affected Silvergate, which is someone we borrowed real estate money from
Sure.
in the past. But what's your take if you're going out there looking for a 60 to 70% LTV loan? Who's in the market right now from the debt perspective?
It's a great question. So the bigger banks got out of the market a while ago when all this started. There's still a few that are in the market. In fact, we've got a couple of calls from some big banks saying, hey, we want to come in and help you out now. The regional banks are really scared on the most part of what's going on with this banking crisis. So with the rising interest rates, they're not sure where cap rates are going. They're not sure where their LTV is today at the buy and what it will be tomorrow at the sell. So they're standing back. So I would say that half of our relationship lenders are not in the market. And I think that speaks to the overall market. We've got some regional banks that we've got debt with that we want to refinance or put another asset that's in the same neighborhood with that debt. And half are saying yes, and half are saying we're not even going to look at it. So I think between interest rates scaring some of the lenders and cap rates scaring some of the lenders and now the banking crisis, I think the field is probably 40% of what it was a year and a half ago.
Does that mean are people transacting, or what's your view of how the number is going to show, let's say, first quarter of 23? Are we down 10% in transactions in industrial? Are we down 30%?
Industrial, again, in the markets where there's still a mark-to-market play, I don't think it's going to be more than, say, 10%. In the markets where the blue states with the loss of population, I think it's going to be much worse than that. So maybe 25% from where we were recently. And I also think that the relationship lenders that are still in business are going to get their pick of business. And California Bank and Trust has been very good to us, and they're quoting everything we're looking at. Other regional banks have not quoted a thing in the last 6 to 9 months.